Welcome back to the Business Leaders of America podcast, where business leaders come to share their advice and journeys to success with existing and emerging leaders of America. Now, here's your host, Dylan Bloyd.
Hello, everyone, and welcome back to the Business Leaders of America podcast. Today, I'm joined by Will Harvey, founder of a private real estate credit firm, Harvey Capital. Will began his career in 2015 as a residential loan officer at a national lender, where he gained a deep understanding of how capital flows through real estate from the inside. Today, he runs Harvey Capital, which operates at the intersection of real estate lending, investing, and disciplined capital management. In this episode, we'll talk about his journey from loan officer to investor and fund manager, how he thinks about risk and opportunity in real estate credit, and what it takes to build and invest with discipline over time. Will, welcome to the show.
Hey, thanks so much for having me, Dylan.
Yeah, absolutely. I'm excited about this, man. So, I'd love for you to take us back to 2015 when you first got into real estate as a loan officer. What originally drew you into the industry, and what did you see early on that made you want to stay?
So I saw an uncapped income. So I didn't, I had worked construction jobs and stuff like that when I
Yeah.
was in college just to make a little bit of money. And I just remember being in those jobs and being like, there is no way I could do this for the rest of my life. And just sitting there punching a clock and
Right.
making a set amount per hour as a salary or an hourly rate just didn't appeal to me at all. So, being a loan officer allowed me to be 100% commission,
Mm,
basically um, where your output is directly influenced by your input.
yeah.
If I work my tail off, then the results should follow, and I should be able to dictate the level of pay that I receive. So that was a big appeal. I was 22 at the time and didn't have a wife or kids or really any obligations. So I saw it as nothing but a positive to be 100% commission.
Right, exactly. And, betting on yourself, right? Versus being, and like you said, the cap is always tough. And when you break into something where you can have unlimited, potential, it kind of changes the game, right?
Yeah, I think so. Yeah.
Yeah, for sure. Well, then fast forward, to 2019, you went out on your own, right? Flipping houses, investing in syndications, really getting your hands on. So what pushed you to take that leap, and what were those early days actually like?
Yeah, so the mortgage business was great. I got started in 2015, learned the business for about a year. I was doing back end work and it was boring, but I got to learn the business and then I jumped out into origination and basically did that for 17, 18 and 19.
Mm,
And while that was awesome and I made good money and I was able to start buying rental properties, it I ultimately was a hamster on a wheel. It felt like I was a hamster on a wheel where there was no I didn't own anything. At the end of the
mm,
day, I was a W-2 employee just making commission,
right.
and it was good pay, but it was still just W-2 income and there was no wealth being created. Now, I was taking that income and buying properties and investing in syndications and that sort of thing, but I really wanted to do my own thing and uh, yeah, I also didn't like how bureaucratic it can be working for a large institutional lender. And I get they have to be that way. It's a heavily regulated space, and you have a ton of employees, but for me, I just wanted to do my own thing, and I've always been kind of a rogue operator, so I started a house flipping company at the end of 2019 with a partner, and that was my focus for the next few years.
Wow. Were there others around you that were doing something similar or that kind of influenced you to kind of take that route? Or was it just kind of like you and the partner were like, hey, we need to do something different?
Well, it was sorta there's a pattern I've seen looking back, and that is that a lot of the best things that I end up doing are accidental, and the house flipping thing was no different.
Wow.
So in mid 2019, I had someone that I had met when I was in the mortgage business. I met him a few years earlier. He was a sort of a part-time real estate agent, and we did, he referred me some business here and there, but he got in touch with me and he was like, "Hey, I have this house flip opportunity, but I don't have the cash. I don't have the, knowledge to know how to go out and get a loan for it." He knew it wouldn't qualify for traditional, bank
Mhm.
financing.
Right.
So he got in touch with me, and I was like, I don't really know how that works either. At the time, I owned a few rentals, and that's when I was getting going, investing in, multifamily syndications. But I didn't know
Mhm.
anything about house flipping, and I didn't really have any desire to house flip.
Yeah.
But he brought me this deal, and he's like, Do you want to go in on this with me?" And he needed someone with some capital and the knowledge of the finance side of things, where and he already had the construction background. He had
Mm.
built houses in a previous, uh r- uh earlier in his career. He worked for a home builder or something like that,
Yeah.
and he had that experience, and he was not intimidated at all with doing a remodel, whereas I didn't know anything
Mhm.
about that. He didn't know anything about the money, so it was kind of this perfect marriage where we each complemented each other's strengths and weaknesses.
Right.
And so we flipped that house. It went well. We made every mistake in the book, but because we bought it at such a good price, we still ended up making, about 50,000 on it, and we rolled
Nice.
that into us starting this house flipping company. And and yeah, that was sorta, I stumbled upon that deal and realized that, flipping houses is a pretty high leverage, high return on time type of thing,
Mhm.
and so we just attacked that, and yeah, I hope that answered your question.
No, yeah, definitely. No, that's awesome, man. And I think a lot of people think of how amazing it would be to flip houses, but they don't really know the intricacies of what goes into it, on the back end, especially like if it's repairs and stuff. I have a brother-in-law who, can do all of that stuff, right, as far as fixing everything. And so it makes a whole lot more sense to be able to do that yourself instead of bringing all these contractors in. And unless, of course, you've already gotten to that point where you can do that, right? Makes it a little bit easier. You don't have to have as much hands-on, but starting out makes it a little bit more difficult when people are like, "I'm just gonna buy a house and flip it," but understand what you're getting into, right?
Yeah, yeah, exactly. And the whole HGTV, they falsely portray what it's what it's actually like, and
Right.
it's totally different than that.
Yeah. No, you're absolutely right. Well,
Yeah.
now, you've built Harvey Capital around a, pretty disciplined approach, things like capital preservation, like you mentioned, margin of safety, and being patient with when you deploy capital, right? So what was that like? Was it always your mindset to have that, or did that evolve through experience in your previous jobs and what you've done?
It's definitely evolved through experience.
Yeah.
And it's learned, and it's also my temperament. So I would
Mm,
say it's a few different things. Um, Temperamentally, I would say that I'm not a particularly emotional person,
oh,
and that definitely helps.
yeah.
Um, Now I have, I get emotional, I get fired up about things, of
Mhm.
course, and I have a drive, but I can sit back and wait and be patient. And there's a good Howard Marks quote. He's a credit investor, and uh, everybody's heard of Warren Buffett,
Right.
Charlie Munger, those value investor guys, but Howard Marks, I feel, is very overlooked. He's got a really, really good book. I forget exactly what it's called, but I'm sure you can look it up.
Mhm.
But he has a quote where, you know, a lot of times the you know, there's the whole saying, don't just don't just stand there, do something,
Yes.
and he says with investing, a lot of times when you're a buy and hold investor, you should flip that, and it's, don't just do something, stand there.
Mm,
you
yeah.
know and I've really tried to take that approach, and invest in things that have a good long-term impact and can compound and have a good team running them, and that's a big focus of mine, and
Right.
it's just sitting there and doing nothing is hard. Human
Yeah.
nature, like we want to do stuff and tinker with it and check our portfolio all the time
Mhm.
but if you study guys like Howard Marks and Warren Buffett and Charlie Munger, I mean, those guys were very successful because they were able to just sit back and detach themselves from all the, day-to-day headlines and just all the chaos of Wall Street and really just make unemotional decisions based on data and not based on just what President Trump said or
Mhm.
what this headline said or whatever. So,
Right.
yeah.
Yeah, you're looking for, big switches in the day-to-day, and it's more day trading, right, compared to long-term investing. And so I know you've said, you'd rather hold cash than deploy into mediocre deals as well. And like you said, it's difficult to sit there and not do anything, but how do you manage investor expectations when patience could essentially mean inactivity?
I think you have to structure everything I think you have to structure your fund or whatever vehicle you're using. If you're using other people's money, then it needs to be structured on the front end where you're getting people that follow that same ethos and
Mm,
have that same long-term outlook. I have a small friends and family fund where the money is tied up for about eight. When I started it, it's from then. This was about 3 years ago, but the money's tied up for 8 years from then.
mm,
So it's not like someone can go in and just liquidate their position. It's a long term thing. And, I have guys in it that are very long term oriented. And that
mm,
was our approach. And, we're not looking at anything month to month or even year to year. It's
yeah.
a almost decade time horizon. And I think that, when you're thinking in decades as opposed to month to month or even year to year, you're just the competition to find value into, do things on a short-term basis is so high. Everybody
Mhm,
wants instant gratification. But if you're able to look out beyond that, uh, and think in years, or even decades,
mhm,
there's almost no competition,
right.
you know,
Yeah.
because nobody thinks that way, or at least very few people think that way. So,
Mhm,
I think that setting everything up properly on the front end and getting partners that are aligned with that belief is very important.
right. I mean, there's always opportunity to diversify, right? You can do some stuff that's short term, but when you want to set yourself up, it's really the long term that's going to make the most sense and give you the best bang for your buck in the long term, right?
Yeah, I think so,
Yeah.
and you shouldn't invest, money that you need in a short period of time. All the people that are in that fund I just described they can afford to lose that money and they can
Yeah.
afford to not get it back for a long time. So,
Hmm.
that's important too.
Right. No, you're absolutely right. I did want to talk about this because, for people who may not fully understand it, can you break down what a first lien bridge loan is and why you've chosen to focus there instead of equity over other parts of, the capital stack?
Yeah, so I did focus on equity for a while. Like I
Yeah.
said, I was doing those syndications
Hmm.
and those were great during 2020, 2021 when everything was ripping.
Yes.
But once interest rates rose, that changed significantly, and it made me realize that there are cycles, and when you're in an equity position, and I should say that all the deals, with the exception of really one, all
Mm,
all the deals are okay.
okay.
They're all doing fine that I've invested in the past, and those are all with my own money. So it's not like I have, investor money in
Right.
any of those, except for one of them. And it's the one that's not doing so good. Um, but you know, I just saw that when shifts in rate happen and these external forces happen, it can really impact things, especially when you're in an equity position behind the all the debt.
Hmm.
Whereas when you're in a first lien position, I mean, you eat first.
Right.
You're the first to get paid, and you're you're usually taking on the most exposure. You know, if you're doing a first lien loan, it's usually 70 or 80% of the property's value. Um, but you're the first to get paid, and there's a path to, um, to get the collateral back. You know, being the property,
Hmm.
if the borrower defaults.
Right.
So um, that's why I like credit, and I sort of shifted to doing more and more credit deals,
Hmm.
for that reason.
Right. It's a little bit less risk, right, as well.
Yeah, yeah, I would say so. I mean, if done right,
Right.
if you're writing bad loans, then of course it's the loans aren't going to be good, and there's
Hmm.
risk there. But all things equal, a good loan versus a good equity position, there's going to be less risk in a good loan that's in first lien position.
Right. Right. No, absolutely. No, thanks for touching on that and explaining that. So, you invest, like you mentioned, you invest alongside your partners in every fund, and how does that actually influence your decision making when you're evaluating a deal?
Yeah, I think when you have your own skin in the game, it just makes you a lot more conscious of. I mean, for me, it's kind of the opposite. With my own money, I've invested in early stage startups. I've
Hmm.
invested in all kinds of stuff that has some stuff has blown up. And um so, I'm a lot more cautious with other people's money than I would say that I am with my own money.
Mm,
Um Now, when you but with that said, when you have a good chunk of your, like, in my case, I have a big chunk of my net worth in everything that I'm doing,
yeah.
and it just makes the alignment uh a lot more. It's not like I'm just getting paid fees to manage this money. You know,
Hmm.
my family's money is invested in this, and if this deal goes south, then that's that's a lot of our net worth wiped out, you
Right.
know? So, just I more so do it, one, because I believe in what I'm doing and the
Hmm.
strategy that I'm doing, and also I wanna show people that that is the case, and show them that I have conviction to put my money where my mouth is, and that this strategy is something that I wanna do, and so yeah, when I'm looking at a deal, y I better do my math correctly. I better do my
Hmm.
research properly, and I better double and triple check everything. Otherwise, I'm gonna have to report to everyone that we suffered a loss, and here's why, you
Hmm.
know?
Right. Yeah. No,
So,
yeah.
uh,
Go ahead.
yeah, I think having that alignment
Yeah.
just really helps.
Yeah, no, I agree. I think that it probably makes them a whole lot more comfortable too, seeing that you also have capital, skin in the game, right? And so, because they're going to be like, okay, if he's doing it, then we know that he's just not taking our money and doing something for, hidden agendas possibly as well, right? Was it difficult to take people's money initially to invest it, or did it make it actually a little bit easier because you did have your own money, and then it's like, okay, I'm doing it together, so it makes, it's gonna make it a little bit easier in the long run because if I lose, we all lose, right?
Yeah, I think the latter.
Yeah.
So,
Okay.
yeah, I think that for me, I'm not a very salesy person. Raising
Yeah.
money is uncomfortable for me. So, when I have my own money in it, and this is the strategy we're doing, the conversation is sort of like, "Hey, the train is leaving the station. This is what we're doing. I have my own funds in this,
Mhm.
and I can show that." I've not hidden that at all.
Right.
My own funds are in this. The train's leaving the station. Here's what we're doing. Do you want to come along for the ride?
Mm.
And that's a lot to me. That feels less like raising money and more presenting someone with an opportunity.
Yeah.
And if they can buy into the strategy and they're a partner that aligns themselves with our time horizon and just our strategy and our long term thinking, then great, they can jump on board, and hopefully we can reach the destination,
Mm.
and it all works out.
Right. No, exactly. So since you're kind of the one who is in charge of it all, when you see like a 40 or 50% return, how do you decide when to exit versus letting it run? Because obviously people who are probably have skin in the game are just like, no, look what it's doing. Let's keep going, but you kind of do I'm assuming running the numbers on it, and making sure that when the right time is the right time. But how do you do that?
Did you find that one from the J.C. Penney deal?
Uh-huh.
Yeah,
I did. Yes.
so the J.C. Penney deal, yeah, that returned almost 50%
Yeah.
annualized in a little over a year, right at a year, I believe.
Hmm.
But yeah, that was a phenomenal one, and to give some background on that deal, this was a publicly traded liquidating trust that was formed in connection with J.C. Penney's bankruptcy filing back in 2020, and in mid 2024, I stumbled upon it and just saw that it was trading incredibly uh, cheaply. It was trading at an implied 14% cap rate,
Hmm.
and they were turning around and liquidating. It was a 14% cap rate on a it was a master lease, 20-year absolute triple net master lease to the new to the new well-capitalized JC Penney operating business. They were the tenant,
Yeah.
and it was trading at a 14% cap rate, which was just insane to me.
Yeah.
And they were turning around and liquidating those properties around 7 caps.
Mm.
So it was basically an arbitrage between public and private real estate valuation.
Mm.
And we bought it at the cheap public price, and they were selling these properties to private buyers, and then returning the proceeds to the shareholders, and it just worked out really well. And I decided to sell. What they were doing was selling properties individually, but then they negotiated a sale of not to get in the weeds, but a
Okay.
liquidating trust has like 5 years to sell, to maintain their tax exempt. Liquidating trusts are, always consult with a CPA, but
Right. Right.
liquidating trust is, from my understanding, federally tax exempt.
Mm.
And the way that it works is you have a certain time horizon where you have to liquidate everything, and they were approaching the end of that. So they were selling properties one by one, and then they negotiated a sale of the entire portfolio. They went under contract, they announced it, and it was just obvious that there was going to be no further upside from there beyond maybe a little bit incrementally,
Right.
but we I was content to just walk away from the table then. And I'm glad I did, because the deal ended up blowing up, and
Oh,
the
really?
price, yeah, the price has dropped, not enough to where I'm excited to buy it again.
Yeah.
But it has dropped substantially from when they announced that a private buyer was going to take over the entire portfolio. So
Yeah.
yeah, in hindsight, it was a good decision, but
Right.
yeah, so that was an interesting one. So I would say, to answer your question,
Yeah.
it's whenever every month they would release they would show the properties they own, the ones that were liquidated, and what's left, what their NOI is. And I would just analyze everything and come to a valuation. Um, and as long as we were still in it with a decent margin of safety between what we paid and what was there, and at the same time the yield was over 12% for us, so just on their rental income, that's before
Right.
any liquidation proceeds. So it was pretty easy to stay in it,
Hmm.
until they announced that sale, and then everything was solidified, and you knew that the upside was capped,
Right.
and that's when we decided to get out. Was when there was no longer that margin of safety, and I would say
Right.
that is when I will usually exit something.
Hmm. Right. Yeah. And I'm sure, the people that you work with and the people work with you appreciate that, the margin of safety. You really take that into account, because sometimes people, will just be like, no, we can keep pushing, we keep pushing. And then all of a sudden, like you said, it crashes or tanks, and, they're going to have a very unhappy customers, right? Clients.
Yeah. Hope is not a strategy.
No. Exactly. Yes. No, you're absolutely right. So what would you say if, someone handed you $10 million today with no constraints, exactly how you deploy it, how exactly would you deploy it over the next 12 to 24 months?
I would probably I would focus on probably hard money first and foremost. It's what I know,
Yeah.
and I like the backdrop. It's residential real estate. We're in first lien position. It's what I know deeply. I used to flip houses, so I understand what it's like to be on the lending side of it and the borrower side of it. And I feel pretty confident in coming up with, at least in my market, coming up with you know, estimates as far as what the value of the property is, and
Hmm.
and just feel like we have a good process to do good loans.
Yeah.
But I would also focus on, if someone handed me 10 mil, I would also focus on uh, public opportunities. So mispriced, just finding those weird, quirky opportunities like that J.C. Penney liquidating trust.
Hmm.
I would try to find things like that in the public markets. They're you got to look, you got to do work, and um, you have to devote a lot of time to it. But I think if you do that, and especially with technology around today with AI and all that,
Hmm.
you can find really interesting mispriced opportunities, and if you stick to that strategy long enough, you should do well.
Right. Right. Yeah. Do you optimize AI a lot in the deals that you're doing?
Yeah, yeah, I would say so.
Yeah.
I would say that I'm pretty AI bullish, and
Yeah.
yeah, it's certainly something that I'm trying to. I think that for the low tech industries like real estate,
Right.
lending, service-based businesses, I think for those businesses, the guys that are adopting AI and really using it to their advantage, um, as a means of either reducing expenses, um, getting better data, making better decisions. I think the ones that can do that effectively are really gonna those are the ones that are gonna take off, and the ones that are slow to adopt or don't adopt at all, I think they're gonna be left behind.
Hmm. Right. Yeah. No, you're absolutely right. I think it really could be in any industry, right? I mean, you're going to have to adapt in some way. You want to use it to optimize your day-to-day operations, and also help predict, potential returns and things like that, because there's a lot of data points that it can pull a lot faster than you can pull, on your
Exactly.
own, right?
Yeah, it should absolutely. I would never go into, Claude or ChatGPT and say, "Hey, ChatGPT, is this a good investment? What do
Right.
you
Yeah.
tell me what you think about this?" That's not what I'm saying. I'm
Yeah.
saying that, like, where I've used it I started using it a couple years ago. I saw the value when you're researching a company. I was researching this one company that I think they owned over 100 properties. It was
Mm,
a REIT, a real estate investment trust, publicly traded REIT, and they owned a bunch of properties. They owned a bunch of industrial properties and then a bunch of office properties. And I was going through and just trying to go property by property and figure out a value for each one.
mm,
And by utilizing by utilizing artificial intelligence, I was able to do that so much faster. And you know I had a much higher degree of I had a much higher level of confidence in the numbers that I was coming up with than if I just Googled or used, however I would have done it before AI existed.
yeah.
And it's really good at pattern recognition and looking at data and spotting trends. And so I think using it for stuff like that is good. But if you're just using it, if you expect to just go into ChatGPT and say, "Hey, ChatGPT, find me something to invest in," that's
Hmm.
not going to work.
Right. I think that a lot of people are using it that way, though, like especially people new to the technology, right? New to AI. I think they are saying, like, what should I invest in? What's a good deal? Is this a good deal? Like, to your point, right? And it could be dangerous. It could actually point you in the
Very.
wrong direction, just because you can't take it for gold, every response you're receiving, because it's always going to
Yeah.
talk to you in a way. It's almost like your cheerleader, right?
Yeah, especially ChatGPT.
You're
I mean,
right.
I
Yeah.
use Claude, and
Right.
and
Right.
I think it's a lot better. But yeah, no, that's exactly right. And eh, understanding how these large language models work and knowing that all they are very, 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 very sophisticated text predictors,
Mhm.
auto text predictors.
Yeah.
That's really all they are. So, if it's bad data in, it's going to be bad data out. So you got to know how to get it to read the right information, and you have to have some level of experience in what you're doing to know uh, what to tell it to get a good response. And
Mhm.
just entering in, hey, is should I invest in Nvidia?
Yeah.
Like
Yeah.
it's just silly.
Right, you're right. Yeah, make sure you're doing the proper prompts, and there's ways to learn a lot about that, and then I
Yeah.
had another guest who had talked about something similar where he just said that, test different, use Perplexity, use Claude, use ChatGPT and have them, compare them versus what their responses are, and have them kind of go back and forth to get a better response even, and so, but at the
Yep.
same time, make sure you're doing proper prompts versus just asking, should I do this? Right.
Exactly.
Right. Yeah. No, absolutely.
Exactly.
Well, I really appreciate you joining today, man. This has been great. I thank you for, spending time with me and the listeners. But for anyone who's listening, want to learn more about what you're building at Harvey Capital, or potentially get involved, what's the best way for them to connect with you?
Yeah, they can go to my website. It's harvey-capital.com, or they can just email me. It's will@harvey-capital.com.
Awesome, amazing. No, that's perfect. And then if they're doing so, I think I saw a couple things on there where it's minimum investment is what was it again? I think it's 100,000.
So I have a new fund that should be launching very soon, and I the offering docs aren't done yet, so I can't
Okay.
talk specifically on that, but it
Mm.
will be likely right around that range.
Got it, got it. Okay, awesome,
Yes.
awesome. All right, yeah, I
Yeah.
just wanna make that clear for the listeners as well, and, definitely some investment opportunities, so please make sure you're checking that out if you're listening, and again, Will, I really do appreciate you joining today and spending time with me and the listeners.
Yeah, thanks so much for having me. It was a lot of fun.